As the weekend progresses, the U.S. markets remain closed. For Datavault AI, trading under the ticker DVLT, the last session on Friday, November 14, 2025, was a very aggressive move. The stock finished the day at $1.83, which was a significant 18.83% climb, or a gain of 29 cents on the day. However, that strength immediately faced headwinds in the post-market session. In after-hours trading, the stock pulled back, closing at $1.75, giving back about 4.36% of those gains. This paints a very conflicting picture of what the market is thinking, and it sets the stage for an extremely important week for the company. That 18.83% surge on Friday wasn't the real story, but rather a symptom of it. The real narrative here is a dramatic, high-stakes tension between the company's aggressive forward-looking statements and the harsh numbers just posted in its financial filings, all while a major short seller report circulates. The expectation that Datavault AI is building for its investors is one of exponential, near unbelievable growth. The company has been actively pushing this narrative. Just last week, on November 13th, the company issued press releases effectively stating it is building faster than the market can price, a bold claim that certainly captured attention. Management has put out staggering revenue guidance. They are targeting $30 million to $50 million for the full year 2025, and they are projecting revenue to exceed $200 million in 2026. This is for a stock that was trading under $2. This guidance is underpinned by talk of $150 million strategic investment agreement with Silex Holdings, which is still pending shareholder approval, and claims of being in dozens of contract negotiations to tokenize real-world assets, or RWAs, a market the company suggests is worth trillions. This is the story the market wants to believe, and it's almost certainly what fueled that Friday rally, traders buying in anticipation of the big story. But then there is the reality. While all that forward-looking guidance was being released, the company also filed its actual Q3 10Q report, the formal financial statement. And the numbers inside tell a very different, much more sober story. For the third quarter, Datavault reported $2.9 million in revenue. While that is a substantial increase from the $1.2 million in the same quarter last year, the costs are terrifying. The company posted an operating expense of $14.9 million. This led to a staggering net loss for the single quarter of $33.0 million. This loss was amplified by non-cash items, specifically fair value changes on notes, but the operational burn is undeniable. Most critically, the filing shows Datavault ended the quarter with only $1.7 million in cash and equivalents. This creates the central conflict of this stock. How does a company with $1.7 million in the bank and a $33 million quarterly net loss credibly plan to achieve $200 million in revenue in 2026 without massive dilution or a complete financial restructuring? This is the reality that is fighting against the $200 million expectation, and it makes that after-hours pullback to $1.75 look less like profit-taking and more like the numbers finally sinking in. This entire situation is made even more complex because this volatility isn't just about fundamentals. This is a battlefield. This stock is at the center of a war between management and a prominent short seller. On October 31st, Wolfpack Research, a firm known for its aggressive reports, initiated a short position in Datavault AI. Wolfpack's thesis was brutal. It called the company's claims about its AI and Web 3.0 technology empty and described its blockchain platform as essentially inactive. The report also targeted leadership, pointing to CEO Nathaniel Bradley's past settlement with the SEC and connections to a convicted felon. Wolfpack argued that the pending $150 million Silex deal wasn't a lifeline, but a source of catastrophic dilution that could nearly double the share count. The report hit the stock hard and established the narrative that DVLT was all talk. Datavault's management did not take this sitting down. On November 3rd, the company issued a formal response, condemning the Wolfpack report as self-serving and malicious and announcing its intention to file a lawsuit against the short-selling firm. But they didn't stop there. In a move that grabbed the attention of the entire retail investing community, on November 11th, Datavault announced a Dream Bowl Draft meme coin dividend. This is a tactic taken directly from the meme stock playbook. This special dividend is explicitly described by the company as an anti-short mechanism. The theory is that by issuing a non-cash dividend, like a digital token, short sellers who have borrowed and sold shares will be unable to deliver this dividend to the share lenders. This failure to deliver could, in theory, force short sellers to close their positions, to buy back the stock, to avoid default, triggering a short squeeze. It's a high-risk, aggressive, and very modern corporate defense strategy, and it's a direct signal to retail investors that management is fighting back. What's your take on this meme coin dividend strategy? Is it a brilliant move to protect shareholders or a desperate gimmick? Let me know in the comments. For investors trying to navigate this, it's crucial to understand the signals. This is no longer a simple buy or sell based on a PE ratio, which the company doesn't even have. You are investing in a conflict. If you're watching this, you need to know where to look for data. You can find short interest data on platforms like Fintel or Ortex, which will show you the percentage of the float that is sold short. As of the last report, it was around 7%, but this data is likely to be updated given the recent events. More important than the amount of short interest is the cost. Watch the borrow cost or borrow rate. If this meme coin dividend strategy works, or if the squeeze narrative gains traction, the cost for short sellers to borrow shares will spike. A borrow rate of 50%, 100%, or even higher is a signal that short sellers are trapped and paying dearly to maintain their negative bet. Also, monitor the days to cover, which tells you how many days of average trading volume it would take for all shorts to close their positions. A high number means they can't get out quickly. But be warned, chasing a short squeeze is one of the riskiest plays in the market. You are not betting on the company's success, you're betting on a technical market dislocation, and the short sellers, like Wolfpack, are often very well capitalized. This battle is made even more confusing when you look at who is buying and who is selling. The short thesis from Wolfpack suggests the company is a shell. Yet Q3 filings show that some major institutions are buying. UBS Group, Vanguard, and JP Chase all reportedly added to their positions in the third quarter. That's smart, patient capital taking a stake. But at the exact same time, company insiders have been selling. Filings from the last 6 months show sales from the CEO, Nathaniel Bradley, as well as the CFO, Brett Moyer, and another executive. This is a classic and very concerning contradiction. When institutions are buying, it suggests belief. When insiders are selling, especially into a story of exponential growth, it raises serious questions about their own confidence in the $200 million forecast. So what does Datavault AI actually do? The company is split into two main parts. First is the Acoustic Science Division, which includes technologies like WISA and audio, focusing on data transmission over sound, using audio signals to verify presence or transmit data. The second, and the one getting all the attention, is the Data Science Division. This is the AI, Web 3.0, and data monetization arm. This division is developing platforms like VerifyU, a credentialing system, and the Information Data Exchange. The big picture idea is that they are building the trusted infrastructure to verify, value, and monetize digital assets and data. The trillion-dollar real-world asset tokenization market they keep mentioning is their target. They want to be the platform that proves a digital asset is real and tradable. The expectation is that this is the future of finance. The reality is that, as Wolfpack claims, many of these platforms are still in their very early stages, and the Q3 report shows they are burning an immense amount of cash to build them. This all brings us to the immediate future. The image from Friday's market close noted an upcoming event, the Q3 earnings call. The search results confirmed this. The call is scheduled for tomorrow, Monday, November 17th at 8:30 a.m. Eastern Time before the market opens. This call is now the entire focal point. The 18% Friday pop was the appetizer. Monday's call is the main event. Management will have the stage. The expectation is that they will use that call to ignore the $33 million loss, dismiss the $1.7 million cash balance as a temporary data point, and double down on the $200 million guidance and the trillions in RWA contracts. The reality is that they will be, or should be, grilled by analysts on the cash burn. How will you fund operations through the next quarter, let alone to 2026? When exactly does the $150 million from Silex close, and what are the final dilution terms? And why are insiders selling their shares if the company is on the verge of explosive growth?